Before we dive in, please remember that the information in this video is for educational and informational purposes only. It is not intended to be a substitute for professional financial, legal, or implementation advice. Every business situation is unique, and you should always consult with a qualified professional before making any decisions based on the content of this presentation. Imagine you're building the new headquarters for your company, a massive gleaming skyscraper. You hire the best architects, you buy the finest steel, the strongest glass, the fastest elevators. You spare no expense. But the entire foundation, the concrete and rebar buried deep in the ground that everything else depends on, you let the interns design it over a weekend. How long do you think that skyscraper is going to last? That is exactly what happens when companies, especially here in the United States, implement Oracle Fusion without first mastering their enterprise structure. It's the single biggest point of failure. It is the digital foundation upon which your entire multi-million-dollar system is built. Get it wrong, and you're not just looking at a few cracks in the wall. You're looking at catastrophic failure, reports that don't run, data that doesn't make sense, intercompany transactions that become a nightmare of spreadsheets, and multi-million-dollar cleanup projects that make executives question the entire investment. I once worked with a US-based manufacturing giant that had to delay their go-live by 6 months, costing them over $3 million in consulting fees and lost productivity, all because they realized 3 weeks before launch that their structure couldn't properly handle state tax reporting for their operations in California versus Texas. A fundamental flaw, buried deep in the foundation, that brought the entire project to a screeching halt. This doesn't have to be you. Over the next 10 parts, we are going to pull back the curtain and demystify the Oracle Fusion enterprise structure, specifically for the unique challenges and complexities of operating a business in the United States. We will give you the blueprint to build your foundation on solid rock. By the end of this series, you won't just understand the theory. You will have the clarity and confidence to design a structure that is scalable, compliant, and built for growth. You will be able to walk into any design meeting and ask the right questions, challenge assumptions, and prevent those costly, career-limiting mistakes before they ever happen. So let's start at the very beginning. What even is an enterprise structure? Forget the jargon for a second. Think of it as the official family tree of your business, as defined inside the Oracle system. It's a hierarchy, a logical model that dictates how your company is organized and how financial information flows through it. It answers the most basic questions. Who are we as a global company? Where do we operate legally? How do we manage our books? Which departments are responsible for which costs? Where do we hold our inventory? It is the skeleton that gives your business its shape and form inside the world's most powerful ERP system. And for companies in the United States, this skeleton is infinitely more complex than it is for many other countries. We don't just have a single federal government to worry about. We have 50 states, each with its own set of rules for payroll tax, sales tax, and income tax. We have concepts like doing business as or DBAs. We have complex legal and reporting requirements from the SEC if we're publicly traded. A one-size-fits-all approach simply does not work. You need a structured design for the American business landscape. So let's lay the first block of our foundation. At the very top of this entire hierarchy, the absolute peak of the pyramid, is one thing: the enterprise. The enterprise is the highest level organization in your structure. Think of it as the ultimate parent company, the holding company for everything else. If your company is called Global Innovations Incorporated, and you have divisions all over the world, Global Innovations Incorporated is your enterprise. Now, here's the key thing to understand about the enterprise level: you don't really do anything here. No invoices are processed, no journal entries are posted, no employees are hired directly into the enterprise itself. Its primary purpose is singular: consolidation. It's the one single bucket at the top that allows the CEO and the board to see a complete, unified picture of the entire global organization. It sets the name of the overall instance, and that's about it. It's simple, but it's the mandatory starting point. You only get one. Okay, so we have our big picture holding company, our enterprise. But a holding company doesn't actually keep the books. For that, we need to go one level down. We need to create the actual set of accounting records. In the Oracle world, this is our ledger. If the enterprise structure is the skeleton, the ledger is the central nervous system and the bloodstream combined. It is the single most important component for your entire financial system. It is the heart of your general ledger, where all your accounting transactions eventually end up. Getting this right is not just important, it's everything. A ledger in Oracle Fusion is defined by three, and only three core components. I call them the 3 C's. And once you set them, they are basically locked in stone. Changing them later is so difficult and so expensive that it's almost unheard of. You must get them right from day one. Those 3 C's are your chart of accounts, your currency, and your calendar. Let's quickly break them down. First, the chart of accounts. This is the very language of your finance department. It's the list of all the accounts your company uses to record financial transactions. Think of it as the DNA of your financial reporting. It defines how you categorize everything, from the cash in your bank account, to the cost of a marketing campaign, to the revenue from your latest product launch. A well-designed chart of accounts gives you incredible insight and flexibility. A poorly designed one will blind you to what's really happening in your business. Second, the currency. This is the currency in which you keep your official books and records. For a US-based company, this is almost always going to be US dollars or USD. This seems obvious, but it's a foundational decision. This primary currency will be the basis for all your financial reporting and legal compliance in the United States. Even if you do business in 20 other currencies, the system will always translate everything back to this one base currency for your main set of books. And third, the calendar. This is your accounting calendar. It defines your fiscal year and the periods within it. Are you a standard January to December calendar year company? Or does your fiscal year start in July? Do you use 12 standard calendar months? Or do you use a 445 retail calendar? This decision impacts everything from when you close your books each month to how you report your quarterly earnings. Like the other 2 C's, once it's set and you've started posting transactions, it is not something you can easily change. So you combine a chart of accounts, a currency, and a calendar, and you have what Oracle calls a primary ledger. This is your main set of books, your golden source of financial truth. Now, you might be thinking, okay, I have a holding company, the enterprise, and I have a main set of books, the primary ledger. I'm ready to start posting invoices, right? Not even close. Because we've built the accounting engine, but we haven't told the system anything about our actual real-world company. We haven't defined the legal entities that are required to do business in the United States. How does the system know which part of our business is registered in Delaware and can legally sign a contract? How does it know which part of the company is responsible for collecting sales tax in Florida? How do we separate the assets and liabilities of one subsidiary from another for SEC reporting? That is where the next and arguably most critical layer of the structure comes in, the legal entity. And understanding how to model your US operations using legal entities is the difference between a smooth, compliant system and an absolute disaster. And that is exactly what we are going to architect step by step in the next part. So let's start with the absolute bedrock, the cornerstone of your entire enterprise structure. In the United States, before you can sell a single product, hire a single employee, or even open a company bank account, you have to do one thing first. You have to go to the government, usually your state secretary of state, and you have to register your business. You might register it as an LLC, a C Corp, an S Corp, but whatever you call it, you are creating a distinct entity that is recognized by law. In the world of Oracle Fusion, we call this the legal entity. And I need you to burn this idea into your mind. A legal entity in Oracle is not just a box you fill in. It is the digital twin of your real-world registered company. It's the who owns the assets, who employs the people, who signs the contracts, who pays the taxes to the IRS. The answer every single time must trace back to a specific registered legal entity. Think about it like this. Imagine you're building a skyscraper. The legal entity is your foundation permit. It's the official document from the city that says, yes, this structure is legally allowed to exist on this piece of land, and the owner of record is XYZ Construction Corp. Without that permit, nothing else matters. The steel, the glass, the floor plans, they're all just a pile of expensive materials. That permit gives the entire project its legal existence. In the US, this is critically important because we don't just have one set of rules. We have federal rules from the IRS, and then we have 50 different sets of state rules. A company registered in Delaware plays by a different set of corporate rules than one registered in California. This is why the first thing you define for a legal entity in Oracle is its jurisdiction. Where is this company legally registered? This decision alone drives countless downstream rules for tax and reporting. Now let's get practical. Most US companies of any significant size are not just one single entity. They are often a collection of them. Let's imagine a hypothetical company, Apex Innovations. On their website, they look like one big happy family. But legally, under the hood, it's a different story. There's Apex Innovations Holdings Incorporated, a C Corp registered in Delaware. This is the parent company. It doesn't really sell anything. Its job is to own other companies. Then there's Apex Manufacturing LLC, registered in Texas. This entity owns the factory, the equipment, and employs all the manufacturing staff. And there's Apex Sales and Service Corporation, registered in New York. This entity employs the sales team and the customer support agents. Why do they do this? 3 big reasons: liability, taxes, and flexibility. If something goes catastrophically wrong at the Texas factory, the lawsuit is against Apex Manufacturing LLC. The assets of the New York sales company and the Delaware holding company are shielded. It creates legal firewalls. Each entity also files taxes differently based on its location and business type. And if Apex ever wanted to sell its manufacturing division, they can sell Apex Manufacturing LLC as a clean, self-contained package. Your Oracle structure must mirror this reality. You would create 3 separate legal entities in the system. Not 1, not 2, 3, each with its own legal address, its own registration details, and most importantly, its own unique identifier. In the United States, the ultimate identifier for any legal entity is the Federal Employer Identification Number, or EIN. It's like a social security number for a business. The IRS assigns it, and it's used for all federal tax filings and payroll reporting. When you set up a legal entity in Oracle, there is a place to put this identifier. This isn't optional. This is the key that links your Oracle system to the United States government. Getting this wrong is like putting the wrong name on your tax return. It's a recipe for chaos. So when we, as architects of this system, begin our work, we start by asking the business a simple question. Show me your legal registration documents. Show me your EINs. We don't guess. We don't assume. We map the real world one-to-one into Oracle. For each of those real-world companies, we create a legal entity. We give it a name, Apex Manufacturing LLC. We tell Oracle it's registered in the jurisdiction of Texas, USA. We input its official registered address, the one the IRS and the Texas state government have on file. And we input its unique identifier, its federal EIN. Now here's where the power of fusion starts to kick in. Once you've defined this legal entity, you start assigning it specific roles or functions. Is this entity a payroll statutory unit? That's Oracle's way of asking. Does this company have the legal authority to hire and pay employees in its jurisdiction? If the answer is yes, you check the box. By doing so, you've just told the entire Oracle payroll module to use this entity's registration and EIN for all payroll tax calculations and reporting for its employees. Is this entity a legal reporting unit? This is another critical function. You're telling Oracle, this entity is responsible for filing its own financial and tax reports to the government. This is what allows you to run a balance sheet or an income statement specifically for Apex Manufacturing LLC, separate from the sales company. It's how you ensure you're paying the right taxes to the right authorities for the right part of your business. The most common and most disastrous mistake companies make is trying to simplify this. They'll say, oh, we're all Apex Innovations. Let's just create one big legal entity for the whole US. This is a catastrophic failure of design. Suddenly, you have one single entity trying to manage payroll tax rules for employees in Texas, New York, and California simultaneously. You can't produce a clean financial statement for just your manufacturing operations. You can't properly track which legal company owns which assets. You've taken your beautifully designed real-world legal structure, the one your lawyers and accountants spent years creating, and you've thrown it in the trash. Instead, you've created a tangled, non-compliant digital monolith that will cause reporting nightmares for years to come. So the rule is simple. Your Oracle enterprise structure must be a faithful reflection of your legal reality. One registered company equals one legal entity in Oracle. No shortcuts. No simplifications. This is the foundation. We've poured the concrete and let it set. We've established who these entities are in the eyes of the law. We've defined their legal identity, their home, and their unique number. They exist. But a company that just exists doesn't make any money. It has to operate. It has to transact. It needs a set of books to record every single financial event, every sale, every purchase, every payroll check. It needs a central nervous system to track every dollar coming in and every dollar going out. We have established the legal who. Now we need to build the financial what? We need to give each of these legal entities a brain. In Oracle, that brain, the single most important financial construct you will ever define, is called the primary ledger. And architecting that is our next critical step. So what exactly is this primary ledger? Think of it like this. If your legal entity is the body, the primary ledger is its financial brain. It's the central nervous system for every single dollar, every transaction, every journal entry that flows through that legal entity. It dictates how that entity thinks, speaks, and remembers everything about its finances. And this brain, this primary ledger, is built from 4 fundamental components. In the Oracle world, we call them the 4 Cs. Get these 4 Cs right, and you've built a powerful, intelligent financial engine. Get them wrong, and you've just created a nightmare that will haunt your company for years. The first, and by far the most important C, is the chart of accounts. The chart of accounts is the language of your business. It's the DNA of your financial reporting. It is the single most critical configuration in your entire system, period. Imagine trying to run a multi-billion-dollar company where the sales department calls a product the X100, marketing calls it the Innovator Series, and finance just calls it Revenue Account 7432. It's chaos. Nobody knows what anyone else is talking about. The chart of accounts solves this. It creates a single universal language that everyone in the organization must speak. It's a structured code that allows you to classify every single transaction with surgical precision. Think of it as the ultimate filing cabinet for your entire company's money. When a dollar comes in or goes out, you don't just throw it in a drawer labeled stuff. You have to label it. Where did it come from? Which part of the company earned it? What was it for? Which project was it related to? This filing system is made up of different sections, or what Oracle calls segments. For a typical US company, you'll see a few common ones. First, you have the company segment. This is your balancer. This answers the question, which one of my legal entities does this transaction belong to? Is this a dollar for US West LLC or US East Incorporated? This segment is mandatory and ensures that your books always balance at the legal entity level, which keeps the auditors happy. Next, you have the cost center or department. This answers, which internal team is responsible for this money? Is this a marketing expense? A research and development cost? A salary for someone in the IT department? This gives you incredible insight into the operational performance of your business. You can see which departments are spending their budgets wisely and which ones are running out of control. Then you have the natural account. This is the what? This is the core of accounting. Was this money spent on office supplies? Was it revenue from a software subscription? Was it a travel expense? This segment tells you the fundamental nature of the transaction itself. You might also have a product or service line segment. This is huge for profitability analysis. You can track exactly how much revenue your flagship product is generating versus how much it costs to produce, market, and sell it. You can see which service lines are your cash cows and which ones are just draining resources. And you could have an intercompany segment. This is for tracking transactions between your own legal entities. When US West LLC provides a service to US East Incorporated, you can't just move money around. It has to be accounted for properly, as if they were 2 separate companies. This segment makes that possible and auditable. Building this structure, defining these segments, is an art and a science. You want it to be detailed enough to give you deep insights, but not so complex that it becomes impossible to manage. And here's the critical part, you have to get it right the first time. Changing your chart of accounts after you've gone live is like trying to change the foundation of a skyscraper while people are still working on the 80th floor. It's expensive, it's disruptive, and it's incredibly painful. This is the language your company will speak for the next decade. Choose your words wisely. The second C is the calendar. The financial calendar is the heartbeat of your business. It dictates the rhythm of your reporting periods. It answers the question, how do we measure time? For most US companies, this is a simple monthly calendar, January to December. 12 periods, nice and clean. But it's not the only option. Some retail companies, for example, use what's called a 4-4-5 calendar. This breaks the year into 4 quarters, where each quarter has 2 4-week periods and 1 5-week period. Why would they do this? Because it ensures that the end of a period always falls on the same day of the week, which is critical for comparing sales from one Saturday to the next. It avoids the problem of one month having 5 weekends and another having only 4, which can wildly skew sales data. The choice of your calendar has a massive impact on your ability to compare performance over time. If you use a standard monthly calendar, you're inherently comparing a 31-day January to a 28-day February. Are you truly comparing apples to apples? For most, it's close enough. But for high-volume businesses, that difference matters. Your calendar defines your pace. It's how you close your books, how you report to Wall Street, how you pay out bonuses. It's the official clock by which the entire financial brain operates. The third C is currency. This one seems obvious for a US company, right? It's the US dollar. And for your primary ledger, that's absolutely correct. The functional currency, the currency in which the legal entity primarily operates and keeps its books, will be USD. But this is where world-class planning separates itself from average implementation. You have to ask, what about the future? What happens when your US company, US West LLC, gets acquired by a European parent company based in Germany? That German parent company reports its global results in euros. They don't want to see your reports in dollars. They need them in euros. This is where Oracle's power shines. While your primary ledger, your legal entity's official brain, thinks and operates in USD, you can create secondary ledgers or reporting ledgers that automatically translate every single transaction into another currency, like the euro, using daily updated conversion rates. This means your US controller can look at their reports in USD, while the CFO in Berlin can look at the exact same data, at the exact same time in euro without anyone having to touch a spreadsheet. You're future-proofing your structure. Even if you're a purely domestic company today, thinking about currency now saves you from a massive redesign project 5 years down the road when you make your first international acquisition. And finally, the fourth C is the accounting convention. If the chart of accounts is the language and the calendar is the heartbeat, the accounting convention is the rulebook. It's the set of principles and standards the financial brain must follow. For any company operating in the United States, this is going to be US GAAP, the generally accepted accounting principles. This is the law of the land for American accounting. It governs how you recognize revenue, how you depreciate assets, and 1,000 other rules that ensure your financial statements are consistent and comparable. This becomes incredibly important when you operate globally. The rest of the world largely uses a different rulebook called IFRS, or International Financial Reporting Standards. They are similar but not the same. It's like the difference between American football and Canadian football. Mostly the same game, but a few key rule differences can change the outcome. By defining your accounting convention as US GAAP, you are telling the system, these are the rules we play by. Enforce them. This ensures compliance, simplifies audits, and provides a consistent framework for financial reporting. So there you have it. The 4 C's. Chart of accounts, the language. Calendar, the heartbeat. Currency, the unit of measure. And accounting convention, the rulebook. Together, they form the primary ledger. They create that financial brain for each of our legal entities. We've given US West LLC a brain, and we've given US East Incorporated a brain. Each one is a self-contained, intelligent financial processing machine, perfectly configured to manage its own world. But here's the problem. We've built these two brilliant individual brains, but right now they're locked in separate rooms. They can't see each other. They can't talk to each other. The CEO of our parent company, Global Motors Corp., can't get a single consolidated view of the entire business. To do that, we need to build the corporate nervous system that connects these brains. We need a way to combine their results, manage them as a group, and let them transact with one another. And that takes us to our next layer of the enterprise structure, the all-important business unit. The business unit is where the work gets done. If the legal entity is the brain, making the strategic decisions and bearing the ultimate legal responsibility, the business unit is the company's arms, legs, and hands. It's the operational force that interacts with the world. It's the part of your company that actually sends an invoice, pays a bill, buys an asset, or manages a project. This is where the rubber meets the road. Think about it. A company like Apex Innovations Incorporated, our US legal entity, doesn't just exist as a concept on a piece of paper in Delaware. It has to do things to make money. It has a sales department that sells products. It has a purchasing department that buys supplies. It has a service department that fixes things for customers. In the Oracle Fusion world, each of these operational functions can be represented by a business unit. So Apex Innovations Incorporated, the legal entity, might decide to create a US sales business unit. The sole purpose of this BU is to manage the sales cycle. It creates customer orders, it generates invoices, and it tracks who owes the company money. This is the domain of accounts receivable. The people working in the US Sales BU live and breathe customer data, sales orders, and invoices. Simultaneously, Apex Innovations Incorporated could have another business unit called US Corporate Services. This BU's job is completely different. Pays the bills. It handles rent for the office, pays the utility companies, buys laptops for employees, and processes expense reports. This is the world of accounts payable. The people in this BU are focused on vendors, purchase orders, and cutting checks or sending electronic payments. Notice the separation here. The legal entity, Apex Innovations Incorporated, is the single legally recognized person that owns everything and is responsible for taxes. But operationally, it has partitioned its work into logical, secure units. The sales team in the US Sales BU has no reason to see the company's electricity bill, and the accounts payable clerk in the US Corporate Services BU doesn't need to see the details of a sensitive sales deal with a major client. Business units are Oracle's primary mechanism for this kind of operational control and data security. They create walls between different functions within the same company. This is one of the most powerful and sometimes confusing concepts for people new to Oracle. Why not just have the legal entity do everything? The answer is scalability and control. Imagine a huge US corporation. It might have one primary US legal entity, but under that entity it could have dozens of business units. There might be an East Coast Sales BU and a West Coast Sales BU, a manufacturing BU in Texas, a research and development BU in California. Each of these units operates semi-independently, managing its own transactions, but they all exist under the protective legal umbrella of the single US legal entity. When you log into Oracle Fusion to do your job, say to enter a supplier's invoice, the very first thing the system will ask you is, which business unit are you working in? Your answer determines everything that follows. It determines which suppliers you can see, which bank accounts you can pay from, and which set of policies and approvals you have to follow. The business unit is your context for work. Now let's go a layer deeper. Within Oracle, you don't just create a business unit and call it a day. You have to tell the system what that business unit is allowed to do. These are called business functions. Think of it like assigning skills to one of our company's limbs. You might create a business unit called US Shared Services. A shared service center is a very common model in the US, where one central group handles common tasks for the entire company to be more efficient. For this US Shared Services BU, you would enable multiple business functions. You'd enable the payables invoicing and payables payments functions, allowing it to process and pay supplier bills. You'd probably also enable the customer billing and collections management functions, so it can also handle sending invoices to customers and chasing payments. This one BU is now a multi-talented operational powerhouse, performing several distinct jobs. Conversely, for our West Coast Sales BU, you might only enable the customer billing function. You want that team to be able to create invoices for the sales they make, but you absolutely do not want them paying the company's vendors. The payment function is not part of their job, so you don't enable it for their business unit. This is how Oracle provides incredibly granular control over who can do what. The business unit defines the operational silo, and the business functions assigned to it define the specific tools and capabilities available within that silo. So, to recap the flow so far, at the very top we have the enterprise. It's the whole organization, the global mothership. Underneath that, for our US operations, we established a legal entity, Apex Innovations Incorporated. This is our brain. The part that is legally recognized, owns the assets, and is on the hook for taxes with the IRS. Now we've given that brain some arms and legs by creating business units like US Sales and US Corporate Services. These BUs are the ones performing the actual day-to-day transactions, sending bills and paying bills. But there's a critical piece of the puzzle missing. The US Sales BU generates an invoice for $1 million. The US Corporate Services BU pays a vendor $50,000. These are just operational events. How do these actions get translated into the language of finance? How do they impact the official financial statements of the legal entity? The brain needs to know what the arms and legs are doing in a way it understands the language of debits and credits, of assets and liabilities. The business unit is processing the transaction, but it needs to post the financial result somewhere. It needs a rulebook, a set of accounts, a financial ledger to record its activity. And this is where the all-important link is made. Every single business unit must be tied to a primary ledger. That ledger contains the chart of accounts, the calendar, and the currency that the business unit will use to record its financial information. And who owns that ledger? The legal entity. This creates the perfect, elegant connection. The business unit does the work. It records the financial impact of that work into a primary ledger. The legal entity owns that primary ledger and uses the information within it to prepare its financial statements, file its taxes, and report its profits and losses. The transaction happens at the BU level, but the financial ownership and reporting responsibility sits at the legal entity level, all connected through the shared structure of the primary ledger. It's a beautiful system of checks and balances, ensuring operational independence while maintaining strict financial and legal integrity. So we have the brain, the legal entity. We have the arms and legs, the business units. And we've just established they need a central nervous system to communicate financial results back to the brain. That system is built around the primary ledger. But what exactly is a ledger? What is this chart of accounts we keep mentioning? How do you build one that gives a US company the reporting power it needs to not only satisfy the IRS, but to actually understand its own business at a deep, granular level? That is the heart of the financial system, and it's exactly where we're going next. To understand this, you have to stop thinking about accounting as just a list of expenses and revenues. That's a flat, two-dimensional view of a multi-dimensional world. A modern chart of accounts, especially inside a system like Oracle Fusion, is more like the DNA of your company's finances. It's a coded language that tells a complete story about every single dollar that moves through your business. Get this structure right and you have a crystal ball. Get it wrong and you're flying blind in a blizzard. So what is it? At its core, the chart of accounts, or COA, is a structured set of codes, what we call segments, that you use to classify every transaction. Think of it like a mailing address. An address isn't just a house number. It has a street, a city, a state, and a zip code. Each piece gives you a more specific location. Transaction is the same. It's not just $500 for office supplies. The real questions are, who spent the $500? What exactly did they buy? Where did they buy it? Why did they buy it? A great chart of accounts answers all of these questions instantly. Let's build one for our US company, Apex Innovations Incorporated. We're not going to build a 30-segment monstrosity. We're going to build a smart, effective structure that gives us maximum insight with minimum complexity. For a typical US company, you'll usually see about 6 or 7 key segments. First and most importantly is the company segment. This is the king of all segments. In Oracle terms, we call this the primary balancing segment. All that means is this is the segment that ensures our fundamental accounting equation, assets equal liabilities plus equity, is always in balance. For every transaction, debits must equal credits within this segment. This is non-negotiable. What does this segment represent in the real world? It almost always represents our legal entity. So for Apex Innovations Incorporated, our US legal entity, we might assign it the code 10. If we later expand and create Apex Innovations UK Limited, we might give it code 20. This single segment ensures that we can produce a complete, balanced, and auditable balance sheet for each legal entity, which is a fundamental requirement for reporting to the IRS and other stakeholders. Okay, that's the who at the highest level. But who inside the company is spending the money? That brings us to our second segment, the department or cost center. This is all about operational responsibility. We have a sales department, a marketing department, an R&D lab, human resources, and an IT team. By creating a unique code for each, say 200 for sales, 300 for marketing, 400 for R&D, we can track budgets and expenses by functional area. When the head of marketing comes to you and says they need more budget, you can instantly pull up a report and see exactly what they've spent their money on so far this year. It introduces accountability. It's how you answer the question, which part of the business incurred this cost? Next up, the third and most traditional segment, the natural account. This is the what? This is what most people think of when they hear chart of accounts. It's the list of actual accounts. Cash, accounts receivable, buildings, accounts payable, common stock, sales revenue, cost of goods sold, salaries expense, and so on. These are the fundamental building blocks of your financial statements. We'll have a code for everything from 10,100 for cash in bank to 50,100 for employee salaries to 75,200 for office supplies expense. This segment tells us the specific nature of the transaction. It's the what did we spend the money on? Now, for US companies operating in more than one state, This fourth segment is absolutely critical: location. Why? Taxes. An operational analysis. If Apex Innovations has an office in California, a warehouse in Texas, and a sales team in New York, we have different tax obligations in each state. We have different payroll taxes, property taxes, and potentially different state income tax liabilities. We need to be able to segregate our financials by geography. By creating a location segment with codes like CA for California, TX for Texas, and New York for New York, we can easily run a profit and loss statement for our Texas operations. We can analyze if our California office is more profitable than our New York office. For a US business, geography isn't just a pin on a map. It's a critical financial dimension. Fifth, let's talk about profitability. How do we know which of our products or services are actually making money? That's where the product line or line of business segment comes in. Let's say Apex Innovation sells two things: a cloud SaaS platform and on-premise hardware. They are completely different business models. The SaaS platform has recurring revenue and server costs. The hardware has manufacturing costs and shipping logistics. By creating a segment to track these, say CS for cloud services and HW for hardware, we can tag every piece of revenue and every related expense to the product line that drove it. This is how you make strategic decisions. This is how you decide whether to double down on your cloud platform or to discontinue a piece of hardware that's losing money. It answers the question, what part of our business did this transaction support? Finally, let's touch on a slightly more advanced but crucial segment for any growing company: the intercompany segment. What happens when Apex Innovations Incorporated in the US pays a bill on behalf of its future UK entity? Or what if the UK entity provides a service to the US entity? Money isn't actually leaving the overall corporation, but it is moving between two separate legal entities. This creates a receivable for one and a payable for the other. The intercompany segment is a special code that tracks these internal transactions, ensuring that when we consolidate our books, these internal loans cancel each other out perfectly. It's the key to maintaining a clean and auditable financial record across your entire global enterprise. So let's put it all together. A single transaction hits the books. In an old system, it might just be a journal entry: debit salaries expense, credit cash. In Oracle Fusion, with our new chart of accounts, it's a rich tapestry of information. A single accounting code might look like this: 10-300-50100CS00. That looks like gibberish, but it's a complete sentence. It tells us the US legal entity, Company 10, in the marketing department 300, paid a salary account 50100 for an employee working in the California office location CA, who supports the cloud services product line product CS. And this was not an intercompany transaction, intercompany 00. Do you see the power? Every single transaction now tells a story. We can slice and dice our financial data in any way imaginable. We can ask questions and get answers in seconds. How much is our California office spending on marketing for the cloud platform? Boom, run the report. What are the total salary costs for our hardware division across all states? Done. This isn't just data entry. This is building a financial intelligence engine. This structure, this chart of accounts, is the single most important configuration you will ever do in your financial system. It defines the very language your business will use to speak about money for the next decade. It's the blueprint for all reporting, all analysis, and all future insights. We've designed the blueprint. We've architected the language. But a blueprint is just a piece of paper, and a language is useless without a place to write it down. We need to create the official book of record where all these transactions will live. That book is called the General Ledger. And defining that ledger with its currency, its calendar, and its connection to our chart of accounts is how we pour the concrete foundation for our entire financial house. So now we have this perfect concrete foundation. It's solid, it's level, and it's built to last. We have our ledger, which is our official book of accounts. We have our currency, the good old US dollar. We have our calendar to mark time, and we have our chart of accounts, that beautiful architectural blueprint for every single transaction. But this raises a critical, and I mean legally critical, question. Who owns this house? Who is on the deed? If the tax man comes knocking, whose name is he going to ask for? If a customer has a dispute, who do they sue? You see, a ledger is just a book. It's a meticulously organized record of financial events. But a book can't own property. A book can't sign a contract. A book can't file a tax return with the IRS. For that, you need a person. Or in the world of business, you need what Oracle calls a legal entity. And this right here is one of the most important building blocks we are going to place on top of our foundation. Get this wrong and the entire structure is built on a lie. Get it right and you have a fortress of compliance. So what is a legal entity? In the simplest terms, it's your company as the government sees it. It's the name on your official registration documents filed with the Secretary of State. It's the entity that has a taxpayer identification number, or an EIN. It is the legal person that owns assets, incurs liabilities, and is ultimately responsible for reporting its financial results to government authorities. Think of it this way. You might have a personal checking account. That account has a record of all your deposits and withdrawals. That's your personal ledger. But the bank and the IRS don't care about the notebook you use to track your spending. They care about you, the individual with the Social Security number. You are the legal entity responsible for that money. In the corporate world, it's the exact same principle. Apex Innovations Incorporated, registered in the state of Delaware, is our legal entity. It's the official, recognized name in the eyes of the law. Now, why is this distinction so important inside an Oracle system? Because everything related to legal compliance and statutory reporting revolves around this concept. When you run a report to calculate your corporate income tax, the system asks, for which legal entity? When you generate a balance sheet to send to the SEC, it's the balance sheet of a specific legal entity. This is the anchor point that ties all of our financial data back to the real world of law, regulation, and taxes. Without it, our chart of accounts and our ledger are just an internal academic exercise. With it, they become the official, auditable record of a real-world business. So how do we connect the foundation we just poured, the ledger, to this new critical component? We perform one of the most fundamental steps in the entire Oracle Fusion setup. We assign the legal entity to the primary ledger. This is the moment of creation. It's the system equivalent of signing the deed to the house. By linking Apex Innovations Incorporated to our primary ledger, we are making a formal declaration. We are saying, this book, this general ledger, with its US dollars, its calendar, and its specific chart of accounts, is the one and only official financial record for this legal company. From that moment forward, every single transaction that posts to that ledger is legally considered a transaction of Apex Innovations Incorporated. It's a simple assignment, just a few clicks in the system, but the conceptual weight of it is immense. It's the handshake between your internal accounting and your external legal obligations. Now, this is where I need you to lean in because we're about to address the single biggest point of confusion I see in every single Oracle implementation. It's a mistake that causes endless reporting headaches and fundamentally misunderstands the enterprise structure. And that is the confusion between a legal entity and a business unit. People use these terms interchangeably in conversation all the time, but in the Oracle universe, they are radically, fundamentally different. They answer two completely different questions. The legal entity answers the question, who are we to the outside world? It's for statutory and legal reporting. It's for the IRS, the SEC, for shareholders, and the courts. A legal entity is all about compliance. A business unit, on the other hand, answers the question, how do we run our business internally? It's for managerial and operational reporting. It's for the CEO, the vice president of sales, the plant manager. A business unit is all about performance and management. Let's make this crystal clear with an example. Imagine a massive US retail corporation. Let's call it Global Retail Incorporated. It's incorporated in Delaware. Global Retail Incorporated is their one primary legal entity in the United States. When it's time to file a consolidated federal tax return, they file it for Global Retail Incorporated. That's the entity the IRS cares about. But does the CEO of Global Retail Incorporated manage the company as one giant blob? Of course not. They break it down. They might have a Western region, a Southern region, and an Eastern region. They might have an electronics division and a home goods division. They might have an online sales channel and a brick-and-mortar channel. Each of these, Western region, electronics division, online sales, these are your business units. They are the operational slices of the company that you use to manage performance, to delegate authority, to control budgets, and to measure profitability. The VP of the Western region is responsible for her P&L. The director of the electronics division is responsible for his sales targets. But when a customer in a store in California, which is part of the Western region, buys a television from the electronics division, who legally made that sale? Global Retail Incorporated. Who has to collect and remit the sales tax? Global Retail Incorporated. Who owns the inventory in that store? Global Retailing. See the difference? Business units are how you manage the company. The legal entity is who the company is. In Oracle, you will create your legal entity, Apex Innovations Incorporated. Then, you will create one or more business units that operate within that legal entity. Maybe we have a consulting services business unit and a software products business unit. Both are part of the same company, the same legal entity. They both post their financial transactions to the same primary ledger. But we use the business unit dimension in our chart of accounts to keep their operational results separate. This allows us to answer both critical questions. The CFO can run a report for the entire legal entity, Apex Innovations Incorporated, to see the company's total financial position for the IRS. At the same time, the head of consulting services can run a report just for his business unit to see if his team is hitting their profitability targets. It's a beautifully elegant design. One legal reality, multiple operational perspectives. So, as we build our enterprise structure, the flow is logical. We started with the blueprint, the chart of accounts. We poured the foundation, the ledger. And now we've established the legal ownership, the legal entity. We've officially planted a flag in the ground and declared to the world, this is Apex Innovations Incorporated, and this is its official book of record. This step gives our financial data its legal identity. It ensures that when we tell the government we made $1 billion in revenue, our system can prove which legal company made that money transaction by transaction. It's the bedrock of auditability and compliance. We've now defined the what, the chart of accounts, the where, the ledger, and the legal who, the legal entity. Our structure is taking shape. It has a foundation and a legal title, but it's still just an empty shell. How do we actually conduct business? How do we process a customer order, send an invoice, or pay a supplier? How do we manage the day-to-day operational pulse of the company? To do that, we need to breathe life into the operational side of the house. We need to open the doors for business. And that means setting up the very business units we just discussed, the engines that will actually drive our company forward. So let's roll up our sleeves and create our very first business unit for US Fusion Innovations. Imagine we're opening our first major office, let's say in Austin, Texas. This isn't just a name on a spreadsheet. This is our operational headquarters for the entire Southwest region. It's where our sales team will operate, where customer orders will be processed, and where invoices will be sent from. It's the beating heart of our regional business. When we go into Oracle Fusion to configure this, the system is essentially going to ask us a series of common sense questions, but in its own specific language. The first and most critical question is, who owns this business unit? Think about it. You can't just open an office on a street corner and start selling things. That office has to be legally owned by a registered corporate entity. It needs a legal identity for contracts, for hiring, for paying taxes. In the world of Oracle, this is called the default legal entity. We already did the hard work of creating our legal entity, US Fusion Innovations Incorporated, registered in Delaware. So when we create our Austin Operations Business Unit, we are explicitly telling the system that this new operational unit is owned and operated by US Fusion Innovations Incorporated. This is a non-negotiable link. Every single transaction that flows through the Austin BU, every sale, every purchase, is legally happening under the umbrella of US Fusion Innovations Incorporated. This is the connection that ensures every dollar is accounted for, and that our company is operating in full compliance with US law. It's the bridge between the operational world and the legal world. Now, once the system knows who owns the Austin office, the next logical question is, where do we record the money? Every sale made in Austin generates revenue. Every expense, like paying the electricity bill or a salesperson's commission, is a cost. All of these financial events can't just float around in space. They need to be recorded in a book of accounts. This is where our primary ledger comes back into the picture. Remember that beautiful chart of accounts we designed? The one with our specific US accounts for assets, liabilities, revenue, and expenses? By linking our Austin business unit to our US primary ledger, we are giving it a direct line to our corporate financial brain. When a salesperson in Austin closes $1 million deal, the system knows exactly how to record that revenue. It knows to debit accounts receivable and credit sales revenue in the US primary ledger, using the chart of accounts we defined. This connection is what makes Oracle Fusion so powerful. It's not just a sales system or a finance system. It's an integrated system. The actions of the business unit, the operational arm, are instantly and automatically translated into financial entries in the ledger. There's no manual reconciliation, no end-of-month scramble to figure out where the money went. The sale happens in the BU, and the accounting happens in the ledger seamlessly. It's one fluid motion. Okay, so our Austin BU is legally owned and financially connected. What's next? The system now asks a more subtle, but incredibly important question. What are the rules of the game for this business unit? Imagine our company, US Fusion Innovations, grows. We open another office in New York City. The business environment in Austin is very different from New York. Customer expectations might be different. The competitive landscape is different. Maybe in Austin we offer all our customers net 30 payment terms. They have 30 days to pay their invoices. But in the more aggressive New York market, we need to be more flexible, offering some strategic clients net 60 or even net 90 terms to win their business. Do we want our Austin sales team to be able to offer New York payment terms? Probably not. We want to maintain consistency and control within each region. This is where something called reference data sets comes into play. Think of a reference data set as a rulebook. We can create a Southwest region rulebook and a Northeast region rulebook. Inside the Southwest rulebook, we define the only available payment term as net 30. Inside the Northeast rulebook, we list net 30, net 60, and net 90. When we set up our Austin business unit, we assign it the Southwest region rulebook. Now, when an Austin salesperson creates a customer order, the only payment term they can even see or select from the drop-down menu is net 30. They are locked into the rules for their specific business unit. This concept applies to all sorts of shared information, customers, transaction types, sales methods. It allows a large U.S. corporation to have different operating procedures for different parts of its business, all while maintaining control and preventing chaos. It's how you give your regional offices the autonomy they need to succeed without letting the whole company spin out of control. You're partitioning your business data, creating firewalls where you need them. So to recap the setup of our Austin BU, we've given it a name. We've assigned it a legal owner, US Fusion Innovations Incorporated. We've connected it to our US primary ledger so we can track the money. And we've given it a rulebook, a reference data set, to govern its day-to-day operations. We've essentially built the four walls of our new office. We've turned on the lights and connected the phone lines. We have a legal basis for operating, a way to account for our finances, and a set of rules to follow. Our Austin business unit is now a recognized, functioning part of our enterprise structure. It exists. It's ready to process transactions. But there's a problem. A big one. We have this beautiful new office, our Austin BU. The sales team is ready to go. They land their first major client. The client wants to buy our flagship product, the Quantum Innovator 5000. The salesperson goes into the system to create the sales order. They type in the customer's name, the product they want to buy, and then they hit a brick wall. Where's the product coming from? Our Austin business unit is a commercial entity. It handles sales, billing, and customer relationships, but it doesn't physically hold anything. It's an office, not a warehouse. It doesn't have inventory. It doesn't know what we have in stock, where it's located, or how to get it to the customer. We've built the storefront, but we haven't stocked the shelves. We have an engine for processing orders, but we don't have a factory or a distribution center to fulfill them. This reveals the next critical layer of our enterprise structure. For our business to actually deliver goods and services, we need to manage our physical supply chain. We need to define the places where we store our products, manage our stock levels, and ship from. In Oracle's language, we need to build our inventory organizations. These are the physical backbone of the company, the warehouses and distribution centers that turn a sales order into a package on a customer's doorstep. Our Austin BU needs to know which warehouse to pull from. Does it pull from a central warehouse in Dallas? Or maybe a smaller local facility right there in Austin? How does the system know if the product is even in stock? This is the next piece of our puzzle. We have to connect the commercial world of business units with the physical world of inventory. We need to build the bridge between making a sale and fulfilling that sale. And that bridge is the final crucial link in our operational structure. This final link is the inventory organization. It's the digital representation of the physical world. It's where the rubber meets the road, where virtual sales orders become actual boxes on a truck. Without it, our entire structure is just a sophisticated accounting machine with nothing to sell. So, what exactly is an inventory organization? In the simplest terms, it's a facility where you store and transact items. It could be a massive distribution center, a manufacturing plant, a small warehouse in the back of a retail store, or even a service truck stocked with spare parts. If you can hold physical inventory there, Oracle Fusion needs a logical inventory organization to represent it. Think of it as the digital twin of your physical location. Every single action that happens in the real-world warehouse, receiving a shipment from a supplier, moving a pallet from one aisle to another, picking an item for a customer order, shipping it out the door, is recorded in its corresponding inventory organization inside Oracle. This is not just about counting widgets. This is the heart of your entire supply chain. It's the central nervous system for logistics. The inventory organization knows exactly how many units of every single product you have. It knows where they are down to the specific aisle, rack, and bin. It knows their value, their cost, and their status. Is it available for sale? Is it undergoing a quality inspection? Is it damaged? The inventory organization holds the single source of truth for your company's most valuable physical assets. Let's go back to our company, Apex Innovations. They've set up their US ledger, their US legal entity, and their US sales business unit. Now they need to manage their products. Apex has 2 major distribution centers in the United States to serve their customers efficiently. One in Dallas, Texas, and another in Philadelphia, Pennsylvania. In Oracle, we would create 2 inventory organizations to mirror this reality. We might call them APX Dallas Distribution Center and APX Philly Distribution Center. These aren't just names, they are distinct, operational hubs within the system. Each one will manage its own inventory, its own receiving and shipping docks, and its own internal logistics. Now for the million-dollar question. We have a business unit in Chicago that handles sales, and we have a warehouse in Dallas that holds the product. How do they talk to each other? How does a sales order created by the Chicago BU result in a shipment from the Dallas warehouse? This is where you build that bridge we talked about. You explicitly link them. In the system's configuration, you tell Oracle that the Apex US Sales BU is authorized to source and sell inventory from the APX Dallas Distribution Center and the APX Philly Distribution Center. This creates an incredibly powerful and flexible model. A single business unit can fulfill orders from multiple warehouses. The system can even be configured to automatically choose the best warehouse based on factors like the customer's location, shipping costs, or current stock levels. A customer in California? Ship it from Dallas. A customer in New York? Ship it from Philly. The business unit handles the commercial transaction, and the system directs the physical fulfillment to the most logical inventory organization. But it gets even more granular, because a warehouse isn't just one big open space. Think about any real distribution center. There's a receiving area where trucks unload. There's a quality inspection area. There's the main storage area for finished goods ready to be sold. There might be a section for returned items, and another for raw materials. To manage this complexity, Oracle uses a concept called subinventories. A subinventory is a logical partition of an inventory organization. It represents a specific area or type of material within your warehouse. So within our APX Dallas Distribution Center, we might create several subinventories. A receiving subinventory for all incoming goods. A finished goods subinventory for products ready to ship. An inspection subinventory for items that need to be checked by quality control. And maybe a return subinventory for processing customer returns. This allows for incredible control and visibility. When a shipment arrives from a supplier, the items are received into the receiving subinventory. Their status is on hand, but not yet available to sell. Once they pass quality control, they are electronically transferred to the finished goods subinventory. Only then do they become available to fulfill customer orders. This digital material flow perfectly mirrors the physical process, ensuring that you never accidentally sell a product that's still sitting on the receiving dock or waiting for inspection. We can go one level deeper. Even within the massive finished goods subinventory, how does a warehouse worker know exactly where to find a specific product? This is where locators come in. Locators are the specific coordinates within a subinventory. They represent the aisle, the rack, the shelf, and the bin. A locator is the GPS address for your product. So, a product's full address inside Oracle might be Inventory Organization, APX Dallas Distribution Center, Subinventory Finished Goods, Locator, Aisle 27 Rack D Bin 03. When a sales order comes in, the system doesn't just say, "Go get a widget from the Dallas warehouse." It generates a pick slip that tells the worker the exact, precise location of that item. This is what enables modern, high-speed logistics. It eliminates wasted time, minimizes errors, and allows companies to ship thousands of orders a day with near-perfect accuracy. Let's put this all together and see the entire operational flow in action. A customer in Arizona places an order on the Apex Innovations website. That sales order is created and booked in the Apex US Sales BU. The business unit is responsible for the pricing, the customer details, and the commercial terms of the sale. The system then needs to fulfill this order. It checks the configuration and sees that the Apex US Sales BU can source from both the Dallas and Philly warehouses. Based on the customer's Arizona address, the system intelligently determines that the APX Dallas Distribution Center is the optimal fulfillment location. It then checks the on-hand quantity in the finished goods sub-inventory within the Dallas org. It finds the item at locator A2703. A pick slip is generated and sent to a warehouse worker's handheld device, directing them to that exact spot. The worker picks the item, scans it, and brings it to the shipping dock. When they confirm the shipment in the system, a cascade of events happens automatically. First, the inventory level at that specific locator in the Dallas org is decreased. Second, a shipping document like a packing slip is generated. And third, and this is the magic that ties everything back together, the system automatically creates the accounting entries. It recognizes that an asset, inventory, has just been converted into a sale. It will debit the cost of goods sold account and credit the inventory asset account in the Apex US primary ledger. Do you see the power of this? The physical action of shipping a box, performed by a worker on a warehouse floor in Texas, instantly and automatically created a balanced accounting journal entry that will be reflected on the company's official financial statements, all managed by the ledger we set up a few parts ago. The commercial world of the business unit and the physical world of the inventory organization are perfectly synchronized, feeding real-time, accurate data into the financial world of the ledger. This is the operational core of Oracle Fusion. The business unit is the customer-facing commercial engine. The inventory organization is the physical logistics and fulfillment engine. And the link between them is what allows a company to seamlessly move from taking an order to shipping a product to recognizing the revenue, all within one integrated system. We've now built the legal structure, the financial structure, and the operational structure. We have entities to obey the law, ledgers to count the money, business units to make the sales, and inventory orgs to manage the products. But there's one final critical dimension we haven't talked about: the human dimension. Who gets to do all this? Who can create a sales order? Who can approve an invoice? Who can transfer inventory? How do you control what thousands of employees can see and do in a system this powerful? The answer is a concept so elegant and so powerful. It's what allows a 100,000 employee corporation to function without descending into absolute chaos. It's called Role-Based Access Control, or RBAC. Now that sounds like a mouthful of corporate jargon, but I promise you the idea behind it is incredibly simple. We're going to use an analogy. Imagine your entire corporation is a massive, gleaming skyscraper. The Oracle Fusion skyscraper. Every floor in this skyscraper represents a major business function. You've got the finance floor, the supply chain floor, the human resources floor, and so on. Now, when you hire a new employee, say a junior accountant named Sarah, you don't just give her a key that opens every single door in the entire building. You wouldn't give her access to the CEO's office, or the factory controls, or the employee records of her own boss. That would be insane. Instead, you give her a specific keycard programmed with very specific permissions. In Oracle Fusion, this keycard is called a role. And this is the heart of the entire security system. Let's break down the different types of keys and permissions Sarah gets, and you'll see how this whole structure comes to life. First, the moment Sarah is hired and entered into the system, she gets the most basic role of all, the employee role. Think of this as the main lobby access card. It doesn't let her into any specific departmental floors, but it lets her into the building. It lets her do things every employee needs to do. View her own payslip, update her own address, request time off. This is what we call an abstract role. It's abstract because it's not tied to a specific job. Everyone gets one. But Sarah is an accountant. Her job is to process supplier invoices. So we need to give her access to the finance floor, specifically the accounts payable wing. To do this, we assign her a job role. In this case, it might be called Accounts Payable Specialist. This job role is like a master keycard for the accounts payable department. It grants her the potential to perform a whole set of functions. She can create invoices, she can validate invoices, she can query supplier information. The job role defines what she can do. It gives her the capabilities. But here is the billion-dollar question. If we just give her the accounts payable specialist role, does that mean she can see and process invoices for the entire global corporation? For the US division, the European division, the Asian division? If our company has 5 different ledgers and 20 different business units, does she have access to all of them? No. And this is the absolute genius of the Oracle security model. Just giving her the job role is like giving her a keycard that could open all the doors on the accounts payable floor, but it hasn't been programmed yet to know which doors to open. We need to add a crucial piece of information. We need to tell the system that Sarah, the accounts payable specialist, only works for one specific part of our enterprise structure, the US West business unit. This is where the magic happens. We combine her job role, accounts payable specialist, with a specific slice of our enterprise structure, the US West business unit. This combination creates a new super-specific role just for her. It's called a data role. Think of it like this. The job role is the function, what you do. The data is the context where you do it. Job role plus data context equals data role. So the system automatically generates a role called Accounts Payable Specialist, US West. When Sarah is assigned that role and she logs into Oracle, the only invoices she can see, the only suppliers she can query, the only payments she can process are the ones that belong to the US West business unit. She is completely blind to everything happening in the US East business unit or the European division. The system has built a digital wall around her, defined by the enterprise structure we so carefully designed. This is unbelievably powerful. You can hire 1,000 accounts payable specialists across the globe, assign them all the exact same job role, but because they are each linked to different business units, the system automatically creates unique data roles for each of them, perfectly constraining their access to only the data they are authorized to see. You set it up once and the security model takes care of the rest. So what is that piece that restricts the data? It's called a security profile. A security profile is basically a rule that says, for this role, only allow access to this specific business unit, or only allow access to this specific ledger, or only allow access to this specific inventory organization. So the real formula is, job role plus security profile equals data role. The security profile is what programs the key card. It takes the powerful accounts payable specialist key and puts a limiter on it. So it only unlocks the doors with the US West label on them. Now let's go one level deeper. Inside a single department like accounts payable, you still don't want everyone to be able to do everything. You might want Sarah to be able to enter invoices, but you don't want her to be able to approve her own invoices for payment. And you certainly don't want her to be able to create a new supplier, enter a fake invoice from that supplier, and then pay herself. This is a classic risk for fraud, and a major concern for any US company governed by regulations like Sarbanes-Oxley. This is called segregation of duties. Oracle handles this with something called duty roles. If a job role is the master keycard to the whole accounts payable floor, a duty role is like a smaller specific key on the keychain. The accounts payable specialist job role isn't one single monolithic permission. It's actually a collection of these smaller duty roles. There's a payables invoice creation duty, a payables payment processing duty, and an invoice approval duty. By bundling these duty roles together, you create a job role. And this is completely customizable. If your company policy states that the person who enters an invoice cannot be the one who approves it, you can create 2 different job roles. One for a payables clerk that has the invoice creation duty, and another for a payables manager that has the invoice approval duty. Now you've enforced your business process and your compliance rules right into the system's security. It's not based on trust. It's built into the digital fabric of the enterprise. So let's put it all together. Let's trace the chain of command for a single click in the system. Sarah, our accountant, logs in. The system sees she has the data role of Accounts Payable Specialist, US West. She navigates to the invoice screen. The system checks her job role, Accounts Payable Specialist, and sees that it contains the duty role for Payables Invoice Creation. So it lets her open the Create Invoice screen. She has the functional permission. She enters the invoice details and tries to select a supplier. The system checks her security profile, which is tied to the US West business unit. It then shows her a list of only the suppliers associated with US West. She has the data permission. She fills out the invoice and clicks Submit for approval. The system then routes that invoice to her manager, Dave. Why Dave? Because Dave has a data role like Payables Manager US West, and his role contains the invoice approval duty. Sarah then tries to navigate to the payment screen to pay that invoice herself. The system stops her. Her job role does not contain the payables payment processing duty. Access denied. Do you see the beauty of this? It's a waterfall of permissions, an interlocking system of what, where, and who. From the broad job role down to the specific duty role, all constrained by the data in a security profile. This is how you let thousands of people work simultaneously in a multi-billion-dollar system without stepping on each other's toes or committing fraud. It's the nervous system of control that runs underneath the entire enterprise structure we've spent all this time building. It's not just an IT feature. It's the fundamental business control that makes the whole thing trustworthy. Every single element we've discussed, the enterprise, the ledgers, the business units, the inventory orgs, they aren't just boxes on a flowchart. They are the anchors for this entire security model. They are the where that gives context and control to everything everyone does. We've built the structure from the highest corporate level down to the individual warehouse rack. We've defined the financial flows, the legal entities, and the operational sites. And now we've wrapped the entire thing in a sophisticated security model that controls every single action. We've built the skyscraper and we've programmed the keycards. There's just one final piece of the puzzle left. How do we bring this all together and see it from the perspective of the end user? How does all this complex structure translate into the simple day-to-day screens that Sarah the accountant or a warehouse worker actually use? How do we tie it all back to the real work that gets done? That is the final crucial link. And the answer lies in two powerful concepts: data security and context. Think of the entire enterprise structure we've built as the invisible architecture of a smart building. The end user, Sarah the accountant, doesn't need to see the wiring, the plumbing, or the foundation. She just needs the lights to turn on in her office, the water to run from the faucet, and the door to open with her key card. When Sarah logs into Oracle Fusion in the morning, the system immediately knows who she is. It knows her job role, her permissions, and most importantly, her default business unit. Let's say she works for US West Appliances. The moment she logs in, her entire world is filtered through that lens. The system has already put on a pair of US West Appliances glasses for her. This is context. Now let's watch her do something incredibly common. Enter a supplier invoice. A supplier, let's call them Precision Parts Incorporated, has sent a bill for $50,000 for components used in the Nevada factory. Sarah opens the Payables Invoices screen. The first thing she does is choose the business unit. The drop-down list she sees isn't a massive list of every BU in the global corporation. It's a short, specific list that her security profile allows her to see. She'll likely just see US West Appliances, and maybe one or two others if her job requires it. She selects US West Appliances. Click. In that single click, a cascade of logic based on everything we've built fires off in the background. The system instantly knows, okay, this $50,000 liability belongs to the US West Appliances business unit. Because we linked that BU to the US primary ledger, the system knows this transaction will be accounted for in US dollars and will follow the US GAAP accounting rules. Because we tied that BU to the Apex Innovations USA legal entity, the system knows that Apex Innovations USA is the legal party responsible for paying this bill. The invoice is automatically stamped, digitally, with its data passport. It now has a clear identity and citizenship within the corporation. Next, Sarah enters the supplier name, Precision Parts Incorporated. The system shows her the supplier details, including the bank accounts where they like to be paid. These details were set up and are shared across multiple business units because we defined our supplier management at a higher level. Efficiency. Then comes the most critical part, charging the expense. Sarah needs to tell the system what this $50,000 was for. She clicks on the distribution line. She needs to enter a department and an account. Let's say it's for the Assembly Line 3 department and the Raw Materials account. When she goes to select the department, she doesn't see a list of every single department in the entire company worldwide. She doesn't see marketing departments from the UK or R&D departments from Japan. She sees a clean, filtered list of departments that are valid for the US West Appliances business unit. The structure acts as a guardrail. It makes it easy for her to do the right thing and very, very difficult for her to do the wrong thing. She can't accidentally charge a Nevada factory expense to a New York sales office. The system simply won't let her. It's not an option in her drop-down. this isn't a suggestion. It's an enforced business rule, and it's all thanks to the structure we so carefully designed. She enters the expense account, raw materials, saves the invoice and submits it for approval. Her manager gets a notification. The manager, also operating within the context of the US West Appliances BU, reviews and approves it. Now let's zoom out and see the magic. That single transaction, that $50,000 invoice entered by Sarah, begins its journey up the chain. First, it immediately impacts the financial position of the US West Appliances business unit. The accounts payable balance for that BU just went up by $50,000. The expenses for the Assembly Line 3 department just went up by $50,000. The manager of that BU can run a report right now and see this transaction reflected in their P&L statement. Second, it rolls up to the legal entity. Because the BU is owned by Apex Innovations USA, this liability now officially belongs to that legal entity. When the corporate legal team needs to understand the total outstanding debts for Apex Innovations USA, Sarah's invoice is included in that total. Third, it all flows into the ledger. That $50,000 transaction is now a journal entry in the US primary ledger. It's a debit to raw materials expense and a credit to accounts payable. It's a tiny but perfect piece of the giant financial puzzle. At the end of the month, when the accounting team runs the trial balance for the US primary ledger, Sarah's transaction is in there, along with hundreds of thousands of others. This trial balance is used to generate the official financial statements for the Apex Innovations USA legal entity. But it doesn't stop there. Remember our corporate ledger? The one for the ultimate parent company, Apex Global Holdings? The balances from the US primary ledger, including Sarah's transaction, are consolidated and translated into the corporate currency, let's say euros, and combined with the results from the UK ledger, the German ledger, and the Japanese ledger. So that one invoice entered by one person in one office has traveled seamlessly from a simple data entry screen all the way up to the consolidated financial statements reviewed by the CEO and the board of directors of a global multi-billion-dollar company. From a single click to the CEO's dashboard. That is the power and the purpose of a well-designed enterprise structure. It's the highway system that allows every single piece of financial and operational data to travel to exactly where it needs to go, securely, accurately, and instantly. Over these 10 parts, we have built that highway system from scratch. We started with the abstract idea of a business and gave it a legal identity with legal entities. We defined its purpose and operations with business units. We created the rulebook for its finances with ledgers and chart of accounts. We organized its physical world with inventory orgs and its human world with departments. We connected everything, creating a logical, unbreakable chain of ownership and accountability. What you've learned through this series is not just technical configuration. It is the language of modern business. This is the digital DNA of a corporation. Understanding the structure is the difference between being someone who just uses a system and someone who understands how the business truly runs. It's the key to unlocking meaningful reports, to asking smarter questions, to troubleshooting problems at their root cause. When you understand that a business unit is not just a name in a drop-down, but a center of operational control with its own P&L, you start thinking like a business manager. When you understand that a legal entity dictates tax and regulatory compliance, you start thinking like a CFO. When you see how an inventory item in a warehouse is linked all the way up to the corporate balance sheet, you start to see the entire interconnected picture. This knowledge is your foundation. Everything else in Oracle Fusion, payables, receivables, supply chain projects, all of it is built on top of this enterprise structure. Without the foundation, you're just learning to use screens. With it, you're learning to architect business solutions. So I encourage you, don't let this just be passive information. Go back, rewatch the parts that were complex. Sketch it out for your own company or a company you know. See if you can identify the legal entities, the business units, the ledgers. Start looking at the systems you use every day not as black boxes, but as the visible expression of this invisible architecture. Because by mastering this one fundamental concept, you have equipped yourself with a new way of seeing. A way of seeing the business not as a collection of chaotic transactions, but as a logical, structured, and deeply interconnected organism. And that ability, that vision, is what will set you apart in your career, today and for years to come. Thank you for taking this journey.